Banks are everywhere in our daily lives, and we trust them with nearly every dollar we earn or spend. But what most people don't realize is that banks have built an entire system designed to make profit from you, often without you ever noticing it. From hidden fees buried in fine print to the way they quietly use your deposits to generate massive returns, banks earn money at almost every step of your financial life. In this breakdown, we reveal the subtle, overlooked, and sometimes surprising ways banks profit from you behind the scenes, so you can finally understand how the system really works. Today we'll talk about how banks make profit from you without you knowing. So, before we start, make sure to hit the like button and subscribe to my channel. 1. The spread. Banks lending your money at higher rates than they pay you. The primary way banks make money is through the interest rate spread, which is the difference between what they pay depositors and what they earn when lending those deposits. When you deposit money into a savings or checking account, the bank pays you a tiny interest rate, often as low as 0.01% for standard accounts. Yet the bank can take that same money and lend it out via credit cards, personal loans, car loans, and mortgages, earning interest anywhere between 4% and 30%, depending on the product. This gap between little paid to you and much earned from borrowers is one of the quietest profit engines in modern finance. The important detail is that you don't earn money based on how the bank uses your funds. You earn based only on your deposit's interest rate. Meanwhile, the bank earns based on higher yield activities. This system essentially allows banks to profit off your idle money without you ever seeing the real gains they capture. 2. Fractional reserve banking. Making money with money they don't even have. Banks do not keep all your deposited cash on hand. Through fractional reserve banking, they are allowed to lend out a large portion of your deposits, while keeping only a small percentage in reserve. The surprising part? This process multiplies the money supply, allowing the bank to profit from funds far exceeding what customers actually deposited. They can lend out the same dollar multiple times in different forms, each time earning interest. This profit mechanism operates entirely behind the scenes, and from the customer's perspective, nothing appears unusual. You can still withdraw your money at any time because banks rely on the fact that not everyone will withdraw simultaneously. The system is legal, designed into national financial regulations, and extremely profitable. It means banks can essentially create credit out of thin air, then charge borrowers for the privilege. 3. Hidden fees embedded in everyday transactions. Many bank fees are not prominently advertised. They are buried in terms and conditions, silently deducted from your account, or triggered by behaviors you didn't know were costly. Common examples include overdraft fees, which can range from $25 to $40 per occurrence and often pile up quickly. Insufficient funds fees, even when the bank simply declines a transaction. Monthly maintenance fees for not meeting minimum balance requirements. International transaction fees added quietly to card purchases. Foreign ATM usage fees, often doubled by both your bank and the ATM owner. Paper statement fees, charged just for having your account printed. Banks design these fee structures strategically. They appear avoidable, but in practice many customers end up paying them due to minor mistakes or lack of awareness. These small charges collectively generate billions in revenue annually. 4. Interchange fees every time you use your card. Every time you swipe a debit or credit card, the merchant pays an interchange fee, a small percentage of the transaction amount. While these fees are technically charged to businesses, banks indirectly benefit because merchants often raise prices to offset these costs. That means customers end up paying more, even though they don't see the bank's involvement. This fee structure guarantees banks a small profit on millions of daily transactions, creating a steady revenue stream built from seemingly invisible micropayments. 5. Credit card interest and penalties. The real goldmine? Credit cards may look like convenient tools, but they are among the most profitable financial products ever created. Banks earn money through high interest rates, often 15%, 30% APR, late payment fees, balance transfer fees, cash advance fees, annual membership fees, compound interest on unpaid balances. Even customers who pay their balance in full help banks earn through merchant interchange fees. But those who carry balances contribute heavily to banking profits. Because credit card debt compounds monthly, customers who fail to pay fully can end up paying far more than the original purchase amount. Banks also use advanced algorithms to predict customer behavior, tailoring credit limits and promotional offers to maximize the likelihood of long-term profit. 6. ATM revenue streams you rarely consider. ATMs generate money not just from withdrawal fees, but through multiple layers of profit. Banks earn when you use another bank's ATM. You use their ATM for transactions that involve fees. Businesses pay to place a bank's ATM on their premises. Card networks, Visa/MasterCard, charge processing fees that partly return to the issuing bank. The ATM network is designed to appear convenient while quietly operating as a steady income machine. 7. The float, how banks quietly earn interest before your money arrives or after it leaves. The float is one of the most subtle and least understood ways banks make money from your transactions without you noticing. It occurs during the period when your money is in transit, either coming into the bank, like a deposit or incoming transfer, or going out, such as a bill payment, check, or ACH transfer. During this processing period, the funds are no longer in your account, yet haven't officially reached the recipient. While you see it as pending, the bank sees it as available capital. Even though modern technology makes instant transfers possible, banks intentionally delay transactions by 1 to 5 days, or even longer in international transfers. Why? Because during this temporary window, when the money is neither available to you nor yet delivered to the other party, the bank uses it to earn interest, invest overnight, or park it in short-term financial instruments like money market funds or treasury bills. These short-term investments may last only hours, but when repeated across millions of accounts and billions of dollars in daily transactions, the earnings become massive. This practice is extremely profitable for banks because it carries zero risk. They're using your money, not their own. The float used to make sense when money physically moved between banks, but today delays are more about profit strategy than technology limits. The bank doesn't need 3 days to verify your paycheck or process your electric bill. It simply uses that time to make money off your money. What makes the float even more powerful is that banks don't need your permission, and you usually don't even notice it happening. You see your transfer as pending and move on, while your bank quietly earns interest on funds that legally aren't quite yours or theirs yet. They exist in a profitable middle ground. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.